Imagine you need a car but don't want to buy one. You can lease it instead. A lease is like a rental agreement. You pay to use something for a specific time. This could be a car, a building, or even a piece of equipment. Leases are everywhere in the business world. Companies lease office space, machinery, and vehicles all the time. It's a flexible way to get what they need without a huge upfront cost. Before 2019, companies in India and many other countries followed old accounting rules for leases. These rules made it tricky to understand a company's true financial position. IFRS 16 came in to simplify things and make financial reporting more transparent. It's like cleaning a messy room. Everything is easier to find. Before IFRS 16, there were two types of leases: operating leases and finance leases. This distinction was based on who really owned the leased asset. Operating leases were like simple rentals. The lease payments were recorded as an expense on the company's income statement. But the leased asset wasn't shown on the balance sheet. Finance leases, on the other hand, were more like loans. The leased asset was recognized on the balance sheet along with a corresponding liability for the lease payments. This two-lease system created confusion. Companies could structure leases to avoid showing debt on their balance sheets. This made it hard for investors and creditors to get a complete picture of a company's financial health. IFRS 16 changed the game. It introduced a single model for lessee accounting. Now, almost all leases are treated like finance leases. This means that companies must recognize a right-of-use asset and a lease liability on their balance sheets for most leases. The right-of-use asset represents the company's right to use the leased asset. The lease liability represents the company's obligation to make future lease payments. Let's say a company leases a factory for 10 years. Under IFRS 16, this lease would result in both an asset and a liability being recognized on the company's balance sheet. The asset reflects the value of having access to the factory for a decade, while the liability represents the obligation to make lease payments over that same period. This change brought transparency to lease accounting. Now, investors and creditors can see the full picture of a company's lease commitments. IFRS 16 is like a rule with a few exceptions. There are certain types of leases that are exempt from the on-balance sheet recognition requirement. One exception is short-term leases. These are leases with a term of 12 months or less. For example, if a company leases a photocopier for 6 months, they don't have to recognize it on their balance sheet. Another exception is low-value assets. These are assets that are inherently of low value, such as laptops or office furniture. The threshold for what is considered low value is determined by each company. These exceptions are designed to reduce the administrative burden of IFRS 16 for companies, particularly for leases that have a minimal impact on their financial position. By understanding IFRS 16, stakeholders can gain valuable insights into a company's financial health, risk profile, and overall transparency.